Good afternoon, ladies and gentlemen. My name is Karen, and I will be your conference operator today. At this time, I would like to welcome everyone to the Global Equity Markets Outlook for 2016, featuring Timothy C. Murray, CFA, and Kurt A. Umbarger, CFA. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If at any time you would like to withdraw your question, please press the pound key. I would now like to introduce Mr. Davenport. Mr. Davenport, you may begin.
Hello all. Thanks for joining the call today. We're very excited to have two experts from Rowe Price talking to us about equity markets, particularly given their international background. Timothy comes from covering global capital markets for the Asset Allocation Group. He's a CFA with a Master's in Finance from Johns Hopkins. And Kurt Umbarger is a global equity portfolio specialist with the International Equity Division. Just for some notes on society events, we'd love to see as much turnout as we could this weekend at our fundraising event for the foundation. All proceeds will go towards the ASFIP Foundation, and we'd also love to see people at our 12th annual forecasting event. T. Rowe has been a great partner for us in making these individuals available during a time of, I think, when we could use some extra guidance, and I'm looking forward to hearing what they have to say about the markets and solving this question of deflation or recession that we seem to be in. So I'll turn it over to you, Kurt and Timothy, and then we'll see what happens. Thanks.
Great. Okay, thanks. I will get us, this is Tim, by the way, and I'm going to get us started on page 2. So the plan is I'm going to talk about the market environment and then turn it over to Kurt, who's going to get into equities more specifically. So if we start on page 2, I think the key thing about 2015 was that it was kind of a wake-up call for investors because we had seen volatility in abnormally low basically for about 3 years, for 2012 through 2014. We saw very low volatility. I think a lot of that had to do with the Fed and other central banks being rather predictable. So investors kind of got used to low volatility. They got a big wake-up call in August of last year as the market started to become much more concerned about China. And now we've moved into 2016, and actually volatility has gone up even more. I can tell you that volatility thus far in 2016, the VIX average in 2016 thus far is 23.4. So a lot of volatility, and we would say basically the two major reasons for that are, one, the concern about the slowdown in China, and two, the collapse in oil prices. So that's resulted in very volatile equity markets. You can see that even though the S&P 500 had a nice kind of flat, modest return of 1.4% in 2015, it was hardly a flat ride getting there. It's a pretty wild ride, obviously highlighted by the depths that we saw there in August and September. So moving along to page 3. So as I said, the two big issues are China and oil. So let's take a little closer look at why those are such big issues and kind of what our outlook is for those. So on page 3, I think the important thing to note is that while if you pay attention to the financial press and the headlines, the things regarding China that you hear the most about are the devaluation of the yuan, the volatility in the Shanghai Stock Exchange, and the slowing GDP growth numbers. But really, those are just symptoms of what is the core problem, and the core problem is industrial overcapacity and a significant amount of corporate debt. And you can see this illustrated on the left-hand chart on page 3. So China had a very robust period of growth from 1995 to 2010. They had GDP growth in the double digits, and it was driven by this huge build out in industrial capacity, and at the same time, tremendous amount of urbanization. So you had a lot of citizens moving from rural areas into industrial areas or urban areas, and actually starting to work at factories, et cetera. As I said, this is a really good thing for the Chinese economy, but ultimately it turns out they went a little too far. You can see that if you look at the dark blue line on the left-hand chart, you can see that China's gross fixed capital as a percent of GDP has actually gotten up to 45% after initially peaking at 40%. And typically when you have this kind of industrial build out, if you look at past examples of this like Japan and Korea, that gross fixed capital as a percent of GDP peaks below 40%. So China probably, in an effort to kind of reignite the economy there at the post-financial crisis period there in 2008 and 2009, they introduced a big stimulus package. And during that time period, they probably got a little overzealous and built too much overcapacity in the industrial side of the economy. Now, the result of too much overcapacity is a significant amount of oversupply. So where China is now is they're just simply producing too much industrial products, things like cement, things like iron and copper and other industrial metals. And when you have this huge oversupply, that results in a huge decline in prices. And you can see this on the right-hand side of the slide. The dark blue line shows you that the price of industrial products has actually collapsed and is now at the point where it's you're seeing a negative 60% drop in prices of a lot of industrial products. And that's resulting in industrial enterprises seeing their profits collapse. So that leads us to a difficult situation, which is basically the only solution is for industrial capacity to be curtailed. So they're going to have to shut down some of the industrial capacity in China. And the problem with that is, one, it creates unemployment because you have displaced factory workers, and two, it creates a lot of companies defaulting on debt. So that could very much result in a recession in China, which would be very bad for the global economy. We do not think that's actually going to happen. And the reason we do not think that's going to happen, there's two reasons. Number one is simply the power of the Chinese government. They are very committed to stability, and they are committed to making sure that this pullback in industrial capacity, while they recognize that it needs to happen, they believe they can do it in a more gradual process than what you would see in a typical capitalist economy where we would have a recession. China, however, believes they can manage that industrial slowdown in a gradual fashion. As a result, you won't get massive unemployment and you won't have massive debt defaults. Our belief is that they have the motivation to do that, and they also have the resources to do that. So we're expecting that to occur. And then the other reason is, if you turn to page 4, you can see that this big problem with the industrial economy is only half of the story in China. The other half of China's economy is driven by services. And that's a new thing. Services has been growing as a share of China's economy. As of 2015, it got just over 50% of GDP. So as a result, while you do have this rapidly slowing, deteriorating industrial economy, the service economy actually has remained quite healthy, and you can see that it's actually accelerating. So what China can do is they can have this gradual shutdown of industrial capacity while you have the services side of the economy take over and support growth and keep growth from collapsing. So that's what we expect to happen in China. End result, though, is while probably not crisis in our viewpoint, at least in the near term, it's going to be a long, slow, gradual process down. And that's bad for the global economy. It's just not a crisis situation. The other one, if we move to the next page, page 5, the other big issue affecting markets is, as I said, the collapse in oil prices. And this is also something that's driven by massive oversupply. If you look on the left-hand chart on page 5, you can see that based on the dark blue line, we are now at a situation where the world is producing about 1.7 million barrels per day more than it is consuming. So you have significant oversupply in the oil market, and that's resulting in a drastic decline in oil prices. We've seen them go from $110 to about $30 a barrel just in the span of 18 months. Now, the reason why we have that huge oversupply problem can be seen on the right-hand chart, and it's basically it's due to the U.S. producing much more than they have in the past because of the advances in U.S. shale technology. You can see that the U.S. has gone from producing just under 6 million barrels per day to just under 10 million barrels per day in the span of just 3 years, from 2012 to 2014. And that has resulted in that massive oversupply. Normally, when you have that kind of a supply shock in the oil markets, in the past, what we've seen is that OPEC has acted to curtail the problem by pulling back their supply and therefore supporting oil prices. However, that's not happening this time, and it's not happening for 2 reasons. The first is that they're hoping that they can essentially drive many of these U.S. oil producers out of business by keeping the prices low. Number 2, you have a lot of distrust within OPEC right now. Essentially, the Saudis are concerned that as they pull back production, that Iran, now that it is free of sanctions, will actually fill in that void. So as a result, you've got significant oversupply in oil, and you do not have any reason to think that that oversupply problem has a near-term solution. We are seeing a significant cutback in CapEx by U.S. oil producers, and you can see the rig count going from 1,600 to below 600 in just the past year. However, you can also see that based on the light blue line, that has yet to really have an effect on production in the U.S. So it's going to take a few years for that supply problem to get corrected. So as a result, we'll have very low oil prices for the time being. So what are the effects of these 2 things? If you move over to slide 6, you can see that the first big effect is that emerging markets, which typically has been the big engine of world growth, emerging markets are slowing dramatically. You've got China, of course, being a big part of emerging markets, but outside of China, you've got the vast majority of emerging markets companies heavily reliant on commodity production, and with commodity prices coming down rapidly, that means emerging markets growth is really challenged and is coming down rapidly. And that means world growth is certainly muted. And we've had basically a very muted cycle. The current U.S. expansion has actually been much more muted compared to past expansions, and we expect that to continue even though we are now 7 or 8 years into the current expansion. The other big effect is that within the U.S. economy, there's this really big divergence between the industrial side of the economy and the services side of the economy. You can see this represented on page 7 on the right-hand chart. You can see that based on PMIs, you can see that manufacturing or industrial has actually fallen into recession. Manufacturing PMI is now below the 50 mark, which represents contraction. But the good news is that if you look at the services side of the economy, here represented by the non-manufacturing PMI, that's actually very strong and is very healthy, is up and around the 55 range with the PMI. The more good news is that the industrial economy is actually a relatively small portion of the U.S. economy. So a lot of people are concerned that we're about to go into recession, but the good news is that if you measure in the industrial side of the economy, which is in recession, that's really only about 14% or thereabouts, depends on how you measure it. Share of U.S. employment would say it's about 14% of our economy. So as a result, the broader economy is actually pretty healthy. Unfortunately, if you look at earnings, S&P 500 earnings, the industrial side of the economy actually is very heavily represented in S&P 500 earnings. So what you have in addition to an industrial recession is you have an earnings recession. So we've had 2 consecutive quarters of negative earnings growth. And so that's adding even further concern among investors about the path of earnings going forward. And essentially what we're seeing because of these two effects is that you've got really huge divergence at the regional level, at the sector level, and at the company level. If you turn to page 8, you can see what I'm talking about as far as the divergence regionally. You look around the various equity markets, and what you'll see is essentially in 2015, in the fourth quarter of 2015, the more you were exposed to oil and China, the worse you did. Meanwhile, if you didn't have significant exposure to those elements, you actually did okay and held in okay. So really significant dispersion at the regional level. If you move to the sector level on page 9, you can see this as well. You can see that those sectors of the S&P 500 that have significant exposure to industrial and oil, such as energy and industrials and materials, you can see those areas have seen earnings collapse, whereas areas that are more driven by innovation, like healthcare and information technology, they're actually thriving and doing just fine. And then kind of your other areas of the economy are also doing pretty well. So as a result, significant dispersion at the sector level. And then finally, if you turn to page 10, there's even more dispersion when you get down to the company level. You can see that companies that have disruptive business models that are taking massive share and as a result are able to grow revenues dramatically despite this muted economic environment, those companies are doing great. And FANG is the big acronym that we've heard a lot about in 2015. You can see how those 4 companies that were the best companies in the S&P 500 in 2015 fared so much better than the rest of the S&P 500, which really most companies in the S&P 500 are flat or down. So that's the situation that we're looking at right now, generally. And with that, I will pass it over to Kurt, who's going to get further into specifics on the equity side.
Well, thank you, Tim. And as Tim mentioned, I'll spend the remainder of the time and open things up for questions by looking a little bit more in terms of regional outlook, how we see valuations and earnings, and then a few additional comments with regards to the 2 big factors that seem to be driving markets today, oil and China. So I guess I'm looking on page 11 to start. I think this is an interesting way to look at valuations. It's doing so on a regional basis with the left-hand chart, and it's doing so on a sector basis on the right-hand chart. The north-south axis would give you the forward PE estimate for the regions and the sectors, and the east-west axis will give you an understanding of how that multiple compares to when we were back in 2007. So if you look at the left-hand chart, you'll see that the U.S. market has been the more expensive market, at least on a PE basis, of late. Trading at close to 17 times forward earnings at the end of the year. Obviously, that's pulled back just a little bit here in terms of what's been happening in 2016. But there are a lot of fundamental reasons why the U.S. has re-rated more than other regions of the world. And frankly, we'll look at them in the next couple of pages, but it's about earnings, and earnings has been much better in the U.S. You can see the mixed sort of situation we find ourselves in Europe. Europe has seen a re-rating of its multiples relative to where we were back in 2007, trading a couple of points cheaper than the United States, but we've yet to see the earnings rebound throughout much of Europe that we've already seen in the U.S. over the last 6 years. But then I definitely have to focus your attention to the lower left-hand portion of the chart where you'll see emerging markets in aggregate as well as the Asia ex-Japan region. And clearly, emerging markets have both derated, and today they stand as the most inexpensive, at least on a price-to-earnings basis, part of the global opportunity set. Now, much of that is for good reason. We've been talking about China and its impact, and China has a lot of ripple effect on the rest of the emerging world and to some extent the developed markets of the world. And so that's been an issue. We've also had the rollover of the whole commodity complex. And so while oil has the market's attention today, really the bear market in commodities started back in 2011 when we started to see iron ore prices and copper prices and other commodity-based metals really began to roll over, and then subsequently we've seen that with the oil price. If you look at the right-hand chart from a sector perspective, I guess there's a few observations I would make. Energy, at least on a price-to-earnings basis, certainly doesn't look inexpensive. Now, it's starting to on a price-to-book basis. So obviously, if you're just looking at the assets that many of the companies have in the ground, they have derated significantly with the oil price coming down, but a lot of those companies look pretty inexpensive on a price-to-book basis, but not so much on an earnings basis, as we're continuing to see a derating revised lower for many of these companies in terms of what they will earn in 2016 and beyond. And that's really what the market is grappling with, is just how low will oil go and where will it ultimately find a new equilibrium price, and I'll share some thoughts on that in a little bit. If you look in the middle of the chart, you'll see the winners of last year. They tend to be relatively towards the top in terms of their valuation levels. So you see technology, you see consumer discretionary, you see healthcare. And these stocks really did have pretty good 2015s. They've also been the area in the beginning of 2016, which has taken on the chin, so to speak, as valuations have been called into question. And then in the lower left-hand quadrant, again, similar to emerging markets, is the financial sector. So the financial sector, despite the fact that balance sheets have certainly improved since the depths of the financial crisis, the financial sector as a whole, in terms of equity market performance, has continued to lag much of the rest of the opportunity set. And that was true in 2015. It's been true on a year-to-date basis in 2016. So a lot of people were expecting the Federal Reserve to increase interest rates 2, 3, even 4 times. The governors actually predicted that there would be 4 increases in 2016. I think the market is certainly questioning whether that's going to happen based on how things have gotten underway in 2016. But there was a lot more optimism, and we were starting to feel this as well at T. Rowe Price, that financials offered some opportunity. But now if we don't see those short-term interest rates going up in the U.S. in particular, I think a lot of investors, including ourselves, have questioned how much progress some of the banks can make with still a pretty muted credit cycle and short-term interest rates not helping their net interest margins. So if I can, I'll take you over to page 12 because I made reference to earnings on a region-by-region basis. This is how we would look at these. If you look on the left-hand chart, you can see, again, since the crisis, the peak in 2007, how the different regions' aggregate profits have moved along. So the green bar, or the green line, I should say, on the left-hand chart is the United States. So it's really the only region in the world, or at least major region, where we have seen profits increase above where they were back prior to the crisis. And so when I mentioned that the valuation re-rating in the U.S. was somewhat justified, certainly from an earnings perspective, and I think we could all debate the quality of these earnings and how they were generated, a lot of talk about financial engineering, but nonetheless, on an earnings per share basis, the U.S. Has definitely seen a recovery. Emerging markets have seen a pretty gradual erosion since 2011, and thus a lot of the underperformance there, and definitely the commodity cycle has been a big part of that. Japan has seen a big boost of late. Japan, it's a really interesting line if you look at this page, the gray line. Japan, at the depths of the crisis, their entire corporate sector did not generate any profit, and that doesn't happen very often. Japan really didn't get back in the game in terms of an earnings recovery until Abenomics was instituted in 2012, and since then the profit recovery has actually been pretty reasonable due largely to the weak yen. We have not seen that in Europe. So if you look at the way we've broken down Europe on this page, you'll see Europe ex-UK as well as the United Kingdom. The profit recovery is yet to occur, and so there's a lot of optimism being built in on the back of what Mr. Draghi is doing and the announcements of QE and even the most recent statements last week of we're still ready to do anything necessary to help the economies. So there's some optimism still out there. I mean, the valuations of Europe is not that much cheaper than the U.S., but they certainly haven't seen the earnings recovery that the United States market has seen. Then if you look at the right-hand chart, we're just disaggregating emerging markets. Asia's been a much better place from an earnings perspective than any of the other regions. You've seen the complete collapse within the EMEA area, that being emerging Europe and the Middle East, on the back of lower commodity prices, and particularly oil. And you've seen something similar with Latin America, which is still very dependent on coal, not as much as they used to be, but still very dependent upon commodity prices for much of their economic situations. So let's talk a little bit more on page 13 about earnings, and it has been a big miss. So when I think about markets, I say, look, we have less Federal Reserve stimulus today. We've certainly moved on from quantitative easing. We've had our first short-term interest rate hike, although interest rates are still very accommodative. We have more quantitative easing and stimulus coming out of Europe and in Japan. That's sort of offsetting what the Fed's done, but nonetheless, I think for the investors' mindsets of late, the move by the Fed definitely was an inflection point. Second, you have less valuation support than what we had 2, 3, 4 years ago in markets. So markets, broadly speaking, we were characterizing as being fairly valued during 2015, and I think that's still the case even with the pullback we've seen to start this year. We have less earnings support, so Tim alluded to this. We've had earnings that have really missed expectations, and that's what this chart is all about. You can see on the left-hand chart on page 13 what the consensus earnings per share forecast has been since September of 2014 to the end of 2015. You've had a derating almost across the board, country by country, Japan the lone exception, but that's certainly not a huge increase in earnings there over that 15-month period of time, all the way through to China, which is at the far right-hand end of the spectrum, where we've seen a big derating in terms of earnings. And so we wonder why markets are jittery and why they're adjusting. You just don't have the backdrop that we had during the big, call it first stages of this bull market. Same thing is true on a sector basis. So the right-hand chart here shows you we have seen a derating in earnings expectations over this same 15-month time period in all of the sectors, some much more extreme than others, as you would expect. Industrials, materials, energy, and the likes of a strong U.S. dollar has been a big part of this, and of course the price collapse in the commodity complex. So let's look at how we thought or how we see things as we go into 2016. A few complicated charts here on page 14, but the left-hand bar chart shows the constituents on a sector-by-sector basis that make up the S&P 500 operating earnings. And there's a few things that I think are interesting. Certainly healthcare and information technology, which are the top green-colored bars, they make up a much larger portion of S&P earnings today than they did back in, say, the depths of the crisis, 2008 and 2009. You'll see financials has been relatively steady in terms of its contribution, and then energy certainly is down from where it was in 2011, and is likely to continue to contract from here, and most certainly will do so. And then you see the very much more steadier elements of the consumption or services-based parts of the economy with the consumer, and that has seen a steady ascension in terms of its contribution to earnings. So earnings, when we go into 2016, our view, and this is really consensus, is that it should be an improvement over 2015. Now, it doesn't feel like it as we've started the first 3 weeks of this year, but we think that the energy headwind, and you can look at the upper right-hand set of bars to get an understanding of this, the energy headwind will be declining as we move through the rest of the year. And so instead of having an S&P 500 contract in terms of earnings per share growth, we think that as we go through 2016, if you look at the bottom right-hand chart, we'll see earnings something in the mid-single digits. We're not looking for robust growth. We need to see a much more material pickup in terms of the global economy, which is not our forecast. But we think that earnings themselves will be better year over year relative to 2015. So if I take you to the next page, we know some of the behaviors that have been driving markets in recent years, and certainly the merger and acquisition activity, which has set all-time records, and the level of cash on balance sheets, which is also very, very high. This continues to sort of fuel a mentality of let's acquire it, not necessarily build it. And I think that this is still likely to be a theme in 2016 because interest rates are not going to be going markedly higher. It will, if anything, start to accelerate those that have not acted to do so. And with the start of the year, with valuations pulling back a little bit and stock prices, in some cases, down 20 to 30% on an individual stock basis, companies that have fallen that much, things could start to get interesting again for those that did not act in 2015, and even for those that did. So we would expect this sort of, and as it's been called, elements of financial engineering to continue. And that's also expressed over on slide 16. So part of what has actually helped earnings in this environment of a strong dollar and weak commodity prices for that portion of the opportunity set has been the net negative equity share issuance in recent years. And so the top chart on page 16 shows you the in billions level of basically buybacks that have been taking place. We don't anticipate that this is going to slow either. This still is a preferred means by which corporate management teams are looking to manage their earnings streams, and we think, again, given the overall weak global economic backdrop that we find ourselves in, this is still likely to be the preferred approach. But it can't go on forever. So we're often asked about what will be the CapEx cycle and will one materialize. So page 17 gives you at least some appreciation for what CapEx looks like in relation to depreciation. And you can see that unless you've been in energy, materials, or utilities, and they're all expressed toward the right-hand side of this chart, you can see that in virtually every other sector or in every other sector, we actually have seen depreciation outstripping CapEx expenditures over the course of the last many years. So this eventually will have to evolve, and we will have to see more CapEx because time and underinvestment ultimately will drive a new cycle in the future. But again, with some of the forces that have been in place and we anticipate will still be with us as we enter this year, it's likely to be a slow and a gradual process. Now, within the energy and the materials complex, we actually expect, CapEx, which is already falling appreciably, to be coming down meaningfully. We will not be seeing the CapEx spending plans that were in place during 2008, 10, and 11, particularly in the energy space. So let's talk a little bit about Europe. We are optimistic, and we share in the optimism of a sort of more robust monetary policy that Draghi is implementing and seems committed to. But we have yet to see it actually transpire in terms of earnings. Now, what we're hopeful of is that much like we saw in Japan, the yen was a big catalyst for an uptick in terms of Japanese earnings growth from 2012 up until 2015. We're expecting something over the next couple of years that at least resembles that, if not approaches it. So if you look at the left-hand chart here, these are consensus analyst expectations in terms of the next 3 years. Europe actually has stronger earnings, revenue, and margin expectations in terms of the improvement on these fronts relative to the S&P 500. And at least in 2015, we do not see the degree of negative revisions in terms of earnings that we had seen in the prior years, 2012 through 2014. So we do find more opportunities in Europe today. We've been very underweight for the most part over much of this bull market cycle, but we do think that Europe offers some interesting opportunities now on a stock-by-stock and country-by-country basis. Japan, we're really entering this phase now where, it is being brought into question, the third arrow, so to speak, under Abenomics. That's even been adjusted by Prime Minister Abe. But if you look at what Japan has tried to do, it's been a combination of monetary and fiscal stimulus, which they have really undertaken an extraordinary experiment, quite honestly, in terms of trying to revive their economy and get some inflation going. This last leg, though, is the most crucial leg, and it's really around corporate governance, it's around capital deployment, and it's around cultural shift and mindset. And there's a lot of reasons to be skeptical about that. I think we're all probably very aware of the demographic situation that Japan finds itself in. So this is no small undertaking, but there are some signs that we're actually beginning to get corporates to behave differently. And that's exhibited here on page 19 with the left-hand chart. You can see, historically, Japanese corporates, they just retained cash. They ran a full, sort of employment model for the benefits of social good, and they retained cash for a rainy day. And that's understandable, but it doesn't necessarily lead to the best sort of profit cycle nor the best productivity and return on equity experience relative to elsewhere in the world. And that's always been the sort of history with Japan for the last couple of decades. But if you look at the most recent 12 to 15 months, you're starting to see a shift in terms of how they're deploying capital. More buybacks and more dividends. So we'll see if this continues. We think it absolutely has to continue, because if you look at the right-hand chart, you'll see that return on equity still in Japan, even though it is meaningfully higher than where it was during the 1990s and certainly during the depths of the crisis, it is still lagging the rest of the world. So you look at single-digit return on equity levels in Japan compared to sort of very low double-digit levels throughout much of the rest of the world, including emerging markets, and they still need to do more work. Let's have a look at Asia ex-Japan, because it is an area within the emerging markets that we are more optimistic about, and certainly the debate about China and how it evolves from here is a meaningful one to have an outlook on Asia ex-Japan, because they are so hinged. But when we think about Asia ex-Japan, they are the net beneficiary in the biggest way of lower energy, materials, and resource prices. So if you think about the percentage of the Asia ex-Japan index relative to, say, Latin America or EMEA, which, as we know, are much more heavily constituted by energy and materials businesses, you can see Asia ex-Japan has about half the amount in those areas compared to Latin America, and about a third of the amount compared to EMEA. So when you think about the emerging world, there are net beneficiaries of lower commodity prices, and it's principally in Asia. India imports 75% of its energy. China is a big net beneficiary of lower energy prices. So we look at that and we say that there will be companies that will benefit as a result of that, and we definitely want to be paying them in our global portfolios. Then you can see the current account balance as a percentage of GDP. Obviously, the more commodity-rich parts of the world, Latin America and Middle East and Africa, are running current account deficits that are actually widening, particularly in the case of Latin America. And then you see the beneficiaries in terms of a current account surplus, and lower commodity prices and energy prices will only further that current account surplus for many of those countries. So let's talk a little bit more about China, a little bit more about oil. So on page 21, and Tim was talking about this, but China definitely has a debt problem, a credit extension problem. If you look at private non-financial credit, this was the most recent statistics we had as of the middle of last year, you can see that China currently around 200% of GDP, so very extensive, and the change since 2007 has been larger than any other country, or at least major country that we track. Korea has had a very similar sort of rise in terms of its credit extension. And then if you compare that, though, to much of the rest of the emerging world, take the likes of Brazil and South Africa and India and Indonesia and Mexico, they're not nearly as indebted, and they certainly haven't relied upon credit extension to the same amount or anywhere near it as China has to try to drive their own growth over the recent years. Now, in the developed markets, we have our own situations, and we know this. Japan is, it's actually, I see many measures that actually have it above 200%, depending upon what gets included, all the way to us in terms of our level of indebtedness. But at least we're deleveraging. At least on whole, we're not extending credit to the same extent that China is. And this is the issue for China. So if you look over on page 22, page 22 shows you a breakdown of where that credit has been extended within China, and you can see that it's grown across the board. It's grown from 12% to 26% over the last 7 or 8 years in terms of the consumer side of the economy, but it's really the small and mid and large businesses, the corporate side of China, that has seen the biggest expansion in terms of debt relative to GDP. You'll see an expansion at the local government level and not so much at the central government level as they've pushed those debt issuances out to the local provinces. But this is what China has to get their arms around. Tim talked about it. We think that they will do so in a gradual manner because the stakes are too high. If you look at page 23, they have the ammunition, so to speak. They have the wherewithal to try to manage this in a gradual slowdown and to try to curb the amount of credit that is being extended, and they seem committed to doing that. They're trying the best they can to not create a hard landing. And I think the one thing that we should all do is separate the Shanghai index from the economic situation in China. Now, the economic situation is definitely slowing. GDP, which we don't fully believe at 6.9% on the most recent print relative to the 12 or 13% that we had seen years ago. It's going to continue to slow from there. That's our core assumption. But we're not looking at a hard landing because we think the government will continue to inject enough stimulus and do enough things to basically bring this down in a way that does not cause social unrest. So when I make the statement that the stakes are too high, the central government in China really wants to, at all costs, prevent social unrest, which they recognize there's a real potential, and that could be devastating for not only the Chinese economy, but in that case, the global economy. The currency has been the main issue, really, that has unnerved investors of late because it's a new sort of game. When the government devalued the yuan in the summer of last year, it was unexpected, and it wasn't managed particularly well. And I think this is what's gotten a lot of investors quite unnerved, is that relative to the past, some of the policy changes that the government has undertaken have not gone as smoothly. Now, I think the right-hand chart on page 24 is interesting because the yuan, which is managed by the government in terms of its peg, has experienced about a 4 to 5% devaluation as of the end of 2015, and there's been ongoing pressure in 2016. That is nowhere near the levels of depreciation against the U.S. dollar that we've seen against other emerging market currencies and developed market currencies, for that matter, as reflected on page 24. If the yuan is allowed, which we do not anticipate, but if it is allowed to devalue sharply, virtually overnight, say 15 to 20%, as some have feared, that would definitely be destabilizing across the emerging markets, as many other emerging countries would have to follow suit. And you'd see further devaluation of their currencies, and obviously that would be tumultuous for the equity markets as well as the developed equity markets as we adjusted through that period. We will be surprised if that's the path that's undertaken, but that is really a big factor that has roiled equity markets thinking about that as something that could occur during 2016. Let's talk a little bit more about oil. Our team at T. Rowe Price has been bearish on oil now for multiple years. We were probably just a little bit too soon, if we were to be honest about that, in terms of calling for lower oil prices. But once this broke, as we know, we've seen a rather extraordinary fall in the oil price from north of $100 a barrel to about $31 as we sit here today. We've been as low as 26. And we're constantly asked, what are you doing? Are you starting to get excited? And the reality is we think that oil prices stay lower for longer. We think that there's still much to work through here in terms of the excess supply relative to demand. There's still a lot of supply coming on board, not least of which will be coming from Iran with the lifting of sanctions. But that's not really what's driving the cycle on a longer-term basis. What we're concerned about, what keeps oil lower for longer, is that the overall cost curve has deflated. And we think that that stays lower for longer, which actually keeps more players in the game, so to speak, more producers. One of the things that we've been looking at and trying to do a ton of work on is what is the cash cost, which is basically the cost to continue your current operations and maintenance of those operations, which we're showing on the chart on page 25. And we're at prices now where we're starting to enter, the upper end of the cash cost curve, which to our minds is a bit of a floor for oil prices. But we're not there across the board. You can see $25 levels for parts of the complex. $30 is really, maybe call it the median cash cost price for most producers, and we're hovering at that now. And that means that people can continue to run their current operations and basically break even. And so there's going to be a wave of bankruptcies. It's going to be forced about because of, when you look at page 26, there is a lot of debt in this space that has been issued. So the level of real debt as a proportion of trailing 12-month U.S. production is at an all-time high, and this is going to flush a wave of bankruptcies. We've already seen what's happened with credit spreads in the high-yield market, which has unnerved a lot of investors. But we need to move through this, and it's not going to be an overnight process. We're going to get consolidation, we're going to get bankruptcies, but we're also going to have a lot of management teams, which they are directly expressing to us. They feel that $30 is unsustainable, so they're continuing to run their supply as if the oil will be back to $60 in 3 years' time. I think it's debatable, but our own view is that we're unlikely to see $60 oil sustained again in the next couple of years. And as a result, if producers aren't cutting back for a new world, then you still got more supply coming on board than is healthy for this current supply-demand dynamic, and we think that that helps keep oil lower for longer. We'll see. It's very difficult. Predicting commodity prices is a lot like predicting currency movements, but all of that said, we still don't make a fundamental case for oil seeing a sustained bounce at these current levels. So what's our conclusions and how would we wrap up? First, I would say that we're looking and expecting greater volatility in markets. That probably goes without saying, given everything we've experienced now over the last 6 months. We have more divergences in the marketplace in terms of economic growth, in terms of monetary policies, in terms of winners and losers. That is creating tremendous opportunity. So from a stock picking perspective, if you think about it being on the right side of the divide, so to speak, on a sector by sector, on a region by region, and on a company by company basis, we actually think this is an interesting time to be putting money to work and to invest in what will be the long-term winners. We do think the U.S. economy is on relatively sound ground. We are not in the camp that we have a recession coming in 2016, but that certainly has been debated in the markets of late. We think that ultimately earnings will be reasonable in 2016 and will help support equity markets, particularly as we get by these fears right now about China and where the oil price settles in. With that, I will stop, and I think we wanted to open things up for questions. Stu, maybe I'll throw it back to you.
Thanks, Timothy and Kurt. Operator, could you ask the callers for questions, and I'll ask you a couple of questions while we're waiting for them to queue up.
As a reminder, participants, if you have a question, please press *1 on your telephone keypad. We will pause for just a moment to compile the Q&A roster.
Kurt, one of the things that you didn't mention in the call was the Fed or talk that much about the currency impact of the stronger dollar. It feels like the Fed's actions, even though they've been telegraphed for almost a year, still weren't very well understood by the market. And I don't know if you can talk about what you think going forward, your forecast for how interest rates, if the Fed is expecting 4 rises, and I've heard now that it's more likely to be 2, how that impacts things and how any more strength in the dollar will also affect the S&P earnings.
I'll make some comments there, and Tim certainly weigh in as well with regards to the dollar. The Fed, and we have been saying this, our chief economist here, Alan Levinson, saying that, look, the Fed seems to be pretty clear in terms of what it's articulating, that they wanted to get off of the zero bound during 2015. I think where markets really started to second guess, how much the Fed was committed to that was when they didn't move in June and September, and the markets had very much warmed up to that at that point. And so that ended up being, particularly the September delay, proved to be quite a shock to the markets, as we recall. and it forced Chair Yellen to come back and immediately try to smooth things over. They're continuing to send a pretty straightforward or at least open message, we think, that they are committed to interest rate increases in 2016. I think the start to this year, both the volatility in the markets and to some extent, specifically what's happening in China, Alan Levinson here is also suggesting that may keep them from moving in March. I mean, we're monitoring this closely, but it may keep them from moving in March. But we still think that as we progress through 2016, the path of short-term interest rates in the U.S. Will be higher. The number of moves, I guess I'll leave it for what the governors have suggested, which consensus right now still remains 4 until we hear otherwise. I think it's very debatable, given what I just said about potentially not moving in March. But I think the path, we would argue, is still for higher rates unless we get a real set of economic data in the United States that suggests we are moving something closer to a recession. But the labor market is not suggesting that, right? I mean, we still have, and it can be a bit of a lagging indicator with, recognizing that, but you're still looking at north of 200,000 jobs per month that have been created over the last 12 plus months. You're getting some signs of wage increases. The housing market, we think, is still actually on the rebound and not contracting. So all of those things tend to underpin, we think, the U.S. economy, which is going to support the Fed moving. Now, as far as the dollar, my only comment there would be is the dollar's moved so much already. So an additional couple of moves from here in terms of short-term interest rates, we don't think has the same impact on dollar strength as what has already been experienced with what the dollar's movement has been over the last 18 months.
Can I just follow on that? If the rest of the world is more aggressively easing, with Japan promising more and Europe promising more and China promising to do whatever it will take, doesn't that send the message that deflation and U.S. higher rates, the disparity is going to grow, not shrink?
Well, in terms of the deflationary issue, I mean, we definitely have call it deflation in some parts of the economy, outright deflation, certainly disinflation in other parts of the economy. We have very little price inflation anywhere in the world. That is probably with us going forward in 2016. We're not calling for a sharp increase in inflationary pressures. And if the yuan devalues, meaningfully from here, let's say another 5 to 10%, that's only further deflationary for the world.
Sure.
So, I would say that the pressure at the moment continues to be downward in terms of price action and the cost of money. And that's going to mean, there's, again, less incentive to really act on the Fed's part to aggressively raise short-term rates. We just think they're trying to find normalization, right? And that normalization, though, is in response to ultra-low interest rates that we've had, but not due to the fact that there's inflationary pressure, because there's little evidence of that. So,
right,
I would say, if you were going down a path of, does that augur for still the bias is towards a stronger dollar? Near term it is, but I guess the point that I would make is that the magnitude of the move in the dollar going from here is likely not to be as great as what we've already seen.
Okay, but I guess I'm just saying that if you're going to say that the Fed will try to do 4 increases, and you're saying that the rest of the world is going to do more things to stimulate and to deflate, and there's a possibility of a Chinese devaluation, doesn't that automatically lead you to a much stronger dollar?
Again, I'd say it does create upward lift to the dollar. But, are we going to see another 20 to 40% move in the dollar as we've seen against the major currencies of the world? I think it's open for debate. Our teams here think that the bulk of the move has happened. But nobody is suggesting that we're anticipating, that the dollar becomes a weak currency from here.
Right.
And if I can just jump in, I think it's important to, like Kurt said, most of this is already priced in, and it has been, since the taper tantrum, markets have been pricing this in. So all of these things are not a surprise. I think the other thing that we also have to think about with regard to the Fed is that they're looking at the U.S. economy. Their mandate has to do with the U.S. economy, and the fears that we have right now about recession are externally driven fears. They're not internally driven fears. So the Fed is in a difficult situation where they're looking at the data that matters to them, and it's telling us no worry about recession, but they know that there is an external threat that they have to be concerned about. One of the good things for them is that might keep them closer to 2 raises than 4 raises this year is the fact that when you do have this strong dollar, that kind of acts as tightening for the U.S. basically, because you essentially get that more difficult monetary conditions, and you get that kind of break on economic activity because of the strength of the dollar.
Okay. Operator, do we have any questions?
Your first question comes from the line of Logan Simpson.
Hey, how's it going?
Hello.
Good.
Hey, so you guys can hear me okay? I'm outside, so I just wanted
Sure.
We can hear you.
All right, cool. I was going to ask what your guys' take is on growth of the U.S., I guess just the S&P as a whole for the next coming couple of years, because right now it looks like we're set for some really strong growth as far as the U.S. economy is when compared to the rest of the world. We have tons of cash that we've been hoarding over the course of the past couple of years. The dollar has much more purchasing power than it has than any time that I can remember. I'm relatively young, so man, I can't remember the last time that the U.S. euro rate was so close. It was probably before I was out of high school. But do you see that it seems like every 7-8 years or so we get into some sort of recession, but there doesn't seem any kind of economic factors that hang out like we had in the past. Like in 2001, we had the dot-com bubble, and then in 2008, we had the housing crash, but nothing really right now as far as the U.S. is concerned. So do you think that it's gearing up for an outperform really for 2017, 2018 after, such statistical favor for what I can see of the U.S. economy right now?
If I can jump in on that, I would say that the setup for the U.S. consumer right now is about as strong as it has ever been or could ever be. You've got rising wages, you've got rising employment, you've got lower prices. Those are great things. And like you say, if you look at the U.S. economy alone in a vacuum, you don't see reasons to think that we're about to hit a recession, even though we are 8 or 9 years into the current expansion. A lot of that is because you've never reached the point of what Greenspan called irrational exuberance. You haven't seen overinvestment. The problem is that there is the potential for big problems in emerging markets. You could get an emerging markets credit crisis. As Kurt showed and some of the charts I showed, there's a tremendous amount of debt that is built up in emerging markets. And a lot of that debt is serviced by companies that their revenues are based on commodity prices, and commodity prices are falling. So there's a concern that you're going to get widespread credit crisis in EM, and that would cause a lot of concern here in the U.S. It would cause markets to fall, and then when you have markets falling, you get a confidence crisis, and that can create its own fundamentals. That can make people, even though their wages have gone up and they have a stable job, they can stop spending because they're concerned based on what they're seeing the stock market do. You also have high yield, which could basically, you've got in the high yield market about just under 20% of the U.S. high yield market is made up of metals and mining companies and energy companies. And those companies are all in a similar situation to where emerging markets are, where they have a fair amount of debt and their revenues are based on the prices of things that are falling dramatically. So you could get this wave of bankruptcies in the high yield market, and that could cause a lot of concern about a credit crisis. A lot of fixed income investors will think, oh, that's the canary in the coal mine. And again, you get markets plummeting and you get confidence going away. So the big concern in the U.S. would be these kind of external factors causing a crisis of confidence. But if you don't get that, everything else about the U.S. outside of energy companies actually looks really, really strong, even though we are well into a bull market and well into an economic expansion.
So do you think that if we get a potential, I guess, an illusion of a fake, not like a real credit crisis, but as far as the emerging markets are concerned, then it gives us tentative, fear creeps in the market, prices drop, and that creates a buying opportunity, kind of like Warren Buffett says, when everybody's scared and selling and stuff, that creates an opportunity for us because the U.S. economy is already set up for, as far as I can tell, really good. Everybody's saving money from low gas prices. I don't know a single person that hasn't complained about that. And so I'm just thinking that, this stems a little bit further with the fear index, and just it drives the S&P a little bit lower for us to all jump on board. And then with all this money leaving the market, it's going to have to come back at some point. And then hopefully the little ships that got on board when the big ships come back will help us little guys out.
All right, so I could let Kurt jump in here in a second, but I guess what I would say about that is probably that is, in our opinion, probably the most likely scenario is that you do end up getting a buying opportunity out of this. But you have to keep in mind that calling the bottom is very difficult. And if people start to believe we're going into a recession, you can see multiples, which in the S&P 500 are around 15, depending on what metric you're using. They can go from 15 to 8 or 9 very quickly. And that, combined with earnings actually contracting, could get you to a really low number. So, yes, I think if you have a long-run perspective and you can wait it out, this is probably a good buying opportunity because, as I said, in the U.S., we really haven't overinvested or overspent like was the case in a lot of past expansions. However, you can get the markets can go way, way lower before that really matters. Like has been said, I believe it was Benjamin Graham who said in the short run, the market is a voting machine. In the long run, the market is a weighing machine. You'd have to wait a long time for that weighing machine to matter, but if you did, you'd probably do okay.
Fair enough. I had one other last question here as far as oil prices. I'm kind of along the lines that it's going to stay like this for a little while longer. I was reading in Investors Business Daily that some of the larger oil producers here in the United States, to get it out of the ground, it was like around $10, $11, and then after all costs are taken into account for, it's about $20. So they're saying it could go even lower, and the largest producers say they're even planning on ramping up production because they can maintain it at that level. So do you see oil prices kind of hanging out at this level for a little bit longer, especially with the sanctions coming off Iran? And it just seems like the supply is going to keep coming, and even if it does try to bounce back with the invention or the whole shale boom, even if prices do creep back up, they could just bring the other pieces back online and then drive prices right back down. So are you guys kind of in the same camp that it's going to be like this for another couple of years or so, or do you disagree with that?
I can weigh in on that. This is Kurt. And so, I mean, our energy team here is, and I think I mentioned this, I mean, lower for longer is sort of the mantra that they've been preaching. For our equity strategies that are not specifically investing only in the commodity complex, meaning they can invest in anything, the recommendation and what we have been doing is to be underweight in energy, and then to own producers that are at the low end of the cost curve and have rock-solid balance sheets. And to put that in perspective, one of our primary global equity strategies at the firm, we're underweight energy and we own 2 stocks, period. So if that's a suggestion to you that, we're not bullish yet, that's exactly what the portfolio manager is intending to communicate, that we still see the fundamentals being very difficult. We see more supply and still outstripping demand, and that's for, at least through the first half of this year. We still think there's going to be a wave of bankruptcy and consolidation ultimately. That will change the backdrop, right? I mean, it's interesting. the energy complex was one of the few areas of CapEx spend with a robust industry cycle going right through the financial crisis and in its aftermath. Now that has reversed, but the beneficiary to that, as Tim was saying and I was saying earlier, we think is ultimately going to be the consumer, which is the larger part of not just the U.S. economy, but the world economy. And as a result of that, when the markets start to appreciate that, we think that there are some good opportunities out there. So, you think about it, the S&P touched the lows of April 2014 during trading last week. Markets have been in a stealth bear market. I think that's the way we would characterize this environment. And it's very easy to get caught up in the sentiment right now that everybody is reading about day in, day out. Oil makes a new low. The S&P is directly correlated with it. We're in this very unusual environment. The correlation coefficient with the S&P 500 and the price of oil was 0.97. This doesn't happen, right? Normally, there's very little direct correlation between the price of a commodity and an overall index. But right now, we are reacting to that as investors around the world because it's creating anxiety along with China. And we think we're going to get on the back side of this. And when we do, much like we've seen in the last 6 years in this bull market, we're going to realize this was another mini episode of what one of our portfolio managers here likes to refer to as a CRIC episode: crisis, response, improvement, complacency. And then it comes back to what do earnings look like. And so earnings are not as robust as they were, but we actually think there's prospect for them to be better in 16 than they were in 15.
Thank you. Appreciate that. Do you think that the correlation has gone away from where it used to be because OPEC is no longer manipulating the prices there? It seemed like for a long time that, oil prices went down. The Middle East didn't care. They're like, well, we want to maintain our economy. We'll just keep manipulating it. But then they couldn't keep up once all these shale companies came in.
Yeah, to be honest, during this brief period of time right now when the correlations have spiked that much, it's difficult to explain it other than it is definitely driving markets. Some fear that it's representative of the overall state of demand and therefore that the global economy is going to be in recession. That's not our view, but you could argue that that's what the markets are trying to indicate. We continue to think it's been what it's been all along. There's just too much supply. And that demand actually in 2015 was at very high levels for oil. Demand did not fall off appreciably. We were just producing too much. So, I can't give you an exact explanation because it's an unusual phenomenon, but we don't think it's going to persist. Eventually we're going to get a new equilibrium price or range for the oil price, and once that happens, markets will get comfortable with it, and we think they'll move on, and hopefully we'll be focusing more on some of the positive effects of low oil as opposed to what's happening to the industrials and the producers right now.
All right. Thank you, guys. Appreciate it.
Do we have another question, Aubrey?
There are no further questions at this time.
All right. Thank you to all the participants and all the people who joined us, and thanks again to Rowe Price for putting this on for us today.
Great. Thank you.
Thank you very much.
All right.
Thank you.
This concludes today's conference call. All presenters, please stay on the line.